All right, pull up a chair. Today, we're really leveling up. We're moving way beyond those basic two-stage models you see in undergrad textbooks, and we're stepping into the real-world, professional-grade techniques we actually use on the trading desk to value high-growth companies and banks. Think of me as your senior analyst older brother showing you the ropes. In today's explainer, we're going to look closely at the math behind the madness.
Here's the game plan for our masterclass today. We'll start by building out a three-stage model, then we'll lock down terminal values and run a real-world case study on Bajaj Finance. After that, we'll map out a sensitivity matrix, and finally, we're going to tackle exactly why traditional DCFs completely fail with banks using HDFC Bank as our capstone. Let's dive right in.
Section 1. The three-stage DCF model. Basically, mapping out the corporate lifespan.
Look, to value a high-flying, real-world company, you can't just assume they're going to grow at 20% forever. It simply doesn't happen. You've got to model their growth a lot like the phases of a human life. Think of it as a timeline where growth decays over time. We start with aggressive youth in years 1 through 5. That's your 20% plus growth, heavy reinvestment, grabbing market share phase. But then, we step down smoothly during a transitioning midlife in years 6 through 10. As the company gets larger, maintaining that massive growth gets a lot harder, and margins start to mature. Eventually, by year 11 and beyond, the company parks at a stable maturity rate. This is usually around 5 to 7%, perfectly matching long-term GDP. At this point, it's just a pure cash generator.
Moving on to Section 2, nailing the terminal value. This is, without a doubt, the anchor of your entire valuation.
Listen closely here, because the terminal value usually makes up 60 to 80% of your total DCF. So getting this wrong means your entire model is, well, absolute garbage. As an analyst, you really have two choices. First, you've got the Gordon growth model, which calculates value in perpetuity. Professor Damodaran heavily prefers this for its theoretical rigor. The absolutely crucial constraint here, your stable growth rate, your G, must be lower than your discount rate and the overall economy's GDP growth. Actually, think about it. If it wasn't, you'd be modeling a company that eventually becomes larger than the entire global economy. No way, right? Then you have the exit multiple method. It's definitely simpler. You just multiply your final year EBITDA by an industry multiple. But reality check, it relies heavily on arbitrary market moods and assumes today's multiples will somehow hold true a whole decade from now. Whenever possible, I always lean toward Gordon growth for a true intrinsic value.
All right, Section 3, valuing Bajaj Finance. Let's actually put this three-stage model into practice.
Let's get to the fun part and run the math on a high-growth beast like Bajaj Finance. The absolute most important thing is starting with a solid base. We're using their FY24 baseline with a net profit of around 14,000 crore rupees, a stellar return on equity of 22%, and a calculated cost of equity of 15.45%. Now, if we run this through our three phases, Stage 1 holding that aggressive 22% growth, Stage 2 smoothly decaying that growth down to 8%, and Stage 3 settling into a stable 6% GDP matching rate, we then discount all those future cash flows back to today. The result? We get a total equity value of roughly 3.64 lakh crore.
Now, here's a massive sanity check for us. If we break down that value, the present value of our terminal value represents over half of our total intrinsic value, 184,000 crore out of the total. This tells you exactly how much of the premium you're paying today relies purely on the company continuing to exist and grow in the very distant future. You have to always respect the weight of the terminal value.
So, when we divide our 3.64 lakh crore equity value by the 62 crore outstanding shares, boom, we land on an intrinsic value of about 5,870 rupees per share. Now, with the market price hovering around 6,500 rupees, this suggests Bajaj Finance is slightly overvalued today. But honestly, it's well within a reasonable range for a high-quality compounder.
Section 4. The sensitivity matrix, or why one-number answers are super dangerous.
Here's a hard truth my desk taught me early on. Any junior analyst can build a model and spit out a single target price. But real veteran analysts, they spend weeks mapping out probabilities, because valuation is a range, not a magical dot. By tweaking our cost of capital on one axis, basically how much risk we perceive, and our terminal growth on the other axis, we reveal a massive value range. Just look at this spread. Depending on tiny shifts in our assumptions, the intrinsic value of Bajaj Finance ranges from 4,950 rupees all the way to 7,650 rupees.
So what do we actually do with all these numbers?
We look for the margin of safety. The math tells us that the median, highly probable target is around 6,000 rupees. But if you want a true margin of safety as a conservative investor, you probably shouldn't be buying unless Bajaj Finance drops closer to the 5,000 mark. That's how you protect your downside.
Moving to Section 5, Why Banks Break DCFs. Time to throw out the traditional playbook entirely.
Okay, so we've mastered standard companies. But if you try applying a traditional free cash flow DCF to a bank, your model's going to completely blow up in your face. This requires a total paradigm shift. Think about it. For a normal company, debt is a liability used to fund operations. But for a bank, debt is literally their raw material. Those deposits are the steel to their manufacturing plant. They mold your deposits into loans to yield a profit. Because of this, traditional metrics like capital expenditures, working capital, and therefore free cash flow are nearly impossible to accurately define. Even the weighted average cost of capital concept makes zero sense here. Plus, the extreme leverage banks use means small asset swings create massive equity value swings.
Because tracking reinvestment is pretty much impossible for a bank, valuation heavyweights like Damodaran tell us we need a completely different approach. We have to scrap the free cash flow model entirely and look directly at equity.
Enter the excess returns model. Instead of cash flows, we judge a bank strictly on its ability to generate returns above its cost of equity on its existing book value. Essentially, the value of a bank is its current book value, plus the present value of any excess returns it'll make in the future. If a bank's return on equity is exactly equal to its cost of equity, it's only worth its book value. Simple as that. Anything extra is where the premium comes from.
Section 6, HDFC Bank Excess Returns. Our capstone bank valuation.
Let's walk through our final boss challenge for this explainer and run the excess returns math for an absolute heavyweight, HDFC Bank. Here's how the math breaks down. Step 1. We start with a baseline book value of roughly 600 rupees per share. Step 2. We calculate the excess spread. HDFC has a great ROE of 17%, and we estimate their cost of equity at 13%. That leaves a nice 4% excess spread. 4% of that 600 rupee book value means they generate 24 rupees per share of pure excess return annually. Step 3. We forecast and discount those excess returns over the next 10 years, plus a terminal value for those excess returns, to find our total premium. That comes out to roughly 550 rupees.
The final step is just simple addition. We take that 550 rupee premium, add it to the 600 rupee base book value, and we get an intrinsic value of 1,150 rupees per share for HDFC Bank. Now compare that to a market price hovering around 1,700 rupees. According to this excess returns model, HDFC is currently quite overvalued. The market is pricing in a massive expectation of future growth and sustained excess returns that might actually be really hard to maintain given the intense competition.
Before we close out, I want to leave you with some ways to sanity check your work, because let's face it, models can be dangerous in the wrong hands. First, try a reverse DCF. Plug the current market price into your model and solve for the implied growth rate. If the market is implying 14% growth for a super mature company over a decade, ask yourself, is that actually realistic? Also, avoid rookie mistakes. Don't make heroic assumptions where growth smoothly glides down perfectly. Real life is bumpy. And never assume a company can out-earn its cost of capital forever. Eventually, competition eats your excess returns. Damodaran calls this the fade pattern, and it happens to everyone.
Ultimately, what I really want you to take away from this explainer is that the numbers on your spreadsheet are just the starting point. They map the expected cash flows based on what we know right now, today. But ask yourself this. If the model only gives you a range of probabilities, what hidden, unmodeled assets, maybe a wild new technology, a massive regulatory shift, or an incredible brand pivot might completely change the game for your investment? Valuations give you the map for sure, but you still have to navigate the real world. Thanks for tuning in, keep learning, keep modeling, and I'll see you next time.